Good evening, traders. Welcome to our risk management session. Today, we want to look at sustainable drawdown for consistent trading. My name is Mathew. This is a continuation of the session which we did on Monday about scaling in and scaling out of the market as a way of risk management. So, how can you set your drawdown such that you are still in the markets, whether it is during turbulent times or whether the markets are trending, where there is something clear? Are you able to remain in the market, remain afloat for the longest, irrespective of the time of the year, the time of the month? And that is what we all look for in trading. So the best thing in this case is to understand the drawdown. When you talk about drawdown is the level that you reduce your trading account. To what level do you reduce your trading account, or up to what amount, or to what extent does your capital reduce while you're trading, or to what extent does it get eaten up? That is a drawdown. And drawdown, what it means in simple terms is you've lost all your money. So it's 100% drawdown. You've blown the account, right? Or anytime you lose your account, your trades, you've lost maybe 50% or half of your account or 70% of your account. What percentage really is sustainable? Of course, a small percentage, but how can you keep track of that? This is something traders should think seriously about, especially when you've already gotten your trading strategy and you exactly know where you're entering your trades and the time you're trading and all that. So risk management, specifically on drawdown. Professional traders keep track of drawdown. When we talk about drawdown, it means if you reach a specific level of loss in a trade or several trades, does it mean that you stop trading for the whole of that day? Does it mean that you have got another one trade to run before you deplete your drawdown? This is what professional traders do. If, for example, you have your capital and you fix your maximum loss in a day at 5%, let's say, for example, and that one might be high. You can set it to whichever you want. Let's say you set your risk in a day at around, let's say 5 or 3% or 10. This one depends with your appetite. And you're looking for something that however much you lose, you're going to sustain yourself in the market for quite some time. So we cannot talk about drawdown without looking at the reward as well. Drawdown is the loss that you're making, the losses that you're making, how much you're losing from your account. But then you're not here, you're not in trading to control the losses only. You're also looking at the profits that you're making. But in this case, because we've previously looked at risk reward, and of course you want a bigger reward, then I want to bring in something else. Win rate. Out of 10 trades, how many do you win? So that even if you maintain a very small loss amount, then when you win, you have a big profit. But then how does it translate into the future of your trading? This one leads us to the next slide, where I want to focus at the win rate versus the risk reward. So first, let's say that you need to decide when you're trading, you maintain a specific level of risk all along. Let's say, for example, you have a $200 account you might want to decide your daily drawdown, right? This is going to help you with your discipline. Daily drawdown, and then maybe weekly drawdown as well. But let's talk about the daily drawdown. You need to have everything in perspective. So let's say, for example, you're doing a 2% risk, or let's say a 2% risk per trade. So you will consider your risk per trade. For example, the risk per trade, risk which you're taking per trade, risk per trade. Let's say, for example, you're doing 2%. 2%. So if it is 2% per trade, then it means 2/100. Let's look at that times 200. These are simple maths you need to do before, so you know what you're going to lose or how you're going to plan yourself. This means $4. So every time you lose, you're losing a -4. Anytime you place your trade and you lose a -4. But then let's say, for example, you take 3 trades in a day or 2 trades in a day. So the first trade you lose 4, right? That's your first trade. And maybe your second trade as well. How much do you lose? You lose a 4 as well. So you might decide daily for the whole day, daily. If I lose $8, then that is where I draw the line. And that day, I'm not entering any trades. That is for example. Okay. But then this is where now you want to consider the risk and the reward. If, for example, like in the case which you're going to look at in our next slide, we will consider a situation where you're losing 10 for every 10 trades, but that's sometimes not very realistic. So you want to have a specific amount which you draw the line during the day. If someone had the same $200 and for example, you fix your loss at -5, every trade you lose 5, 2 trades, the other one you lose 5, and then maximum it is a loss of $10. And that's where you draw the line. If you reach a maximum of -10 in your 2 trades, you stop trading. So that next time you have some time to focus and see where you made your mistakes. And sometimes you want to journal what really made you lose these trades. In this case, hey Kebu, in this case, what it means is you're able to track your losses and have discipline. You are avoiding overtrading, because overtrading is one very bad practice. Overtrading comes with the feeling of trying to recover the losses which you've already done. Like, for example, you've lost $10, you want to look for the next opportunity, whatever time it is, with whichever setup, so you can recover that $10, and then you start becoming emotional in trading. So risk per trade is very essential, and having a daily drawdown is very important. But as well, there's something that we do not remember in trading. You need to think seriously about the win rate. What is win rate? Win rate is the number of times that when you enter your trades with your setup, how many out of those trades, how many do you win? How many do you lose? And this will require a lot of back testing for you to establish the win rate. How many losers do you get? How many winners do you get, for example? So let's work with a trader who is placing several trades, okay? And let's say 10 trades, $10 per trade. That's when it's going to be on the higher side. In a simple way, and you can adopt this, you can go and test this model which I have here. If you're having 1:1 risk reward, like for example, your profit and the loss almost looks the same. If this is your profit right? From your entry. The profit and the loss, they look the same. That is 1:1. Then you need a very high win rate. You need to at least win half of the trades that you enter for you to break even. Break even means the point where your losses and the profits come to zero. So if you have got 1:1, for the people who enter trades and at a stop loss of 5, you get 5, you cut it very fast. Then you need a very high win rate. And for you to be afloat in the market, if you work with a risk reward of 1:1, then you need to win 60% of the trades which you enter, which means if you do 10 trades, you win 6, but only lose 4. That might be a tall order. So I want to see what wins here. In the event where you are targeting twice the loss from your entry, you're targeting twice the loss. If this is your loss, then your profit goes 1, 2 times, right? If it was a buy, for example. So this is -1, then this one is +1, and another +1. So twice. You need to win 40% of your trades and you're in profit. Like if it is 10 trades, 4 trades out of 6 to be on the profitable side. So I want you to see that the higher the reward to the risk, the more better placed you are to be profitable even with one single trade. When you're taking 3 times profit, when you're taking your profit 3 times your loss, okay, like if you've got a loss of -1 and then your profit is like 3 times that loss, like +1, +1, +1, and you are losing 3, then this one means out of 10 trades that you enter, you just need to win only 3 out of the 10 and you're in profits already. Okay. If you're able to target profit 4 times the amount of loss, then with the first trade, if you just win 2 trades out of the 10, you are already on the profit side. So I want you to realize if you're looking at effort versus the reward, when you get trades or when you have a high win rate, when you get trades that give you a bigger reward up to 4 times compared to the risk, then you don't struggle to be profitable. Because in this case, even 2 trades are placing you on the profit. With 3 trades out of the 10, then you're already profitable. If you're able to get a reward of 5 times the loss, you're even better because with the first trade, you're in profits. We can better visualize this one in the schedule, which I'm going to give you. Yeah, Kebu, risk management is very important. You want to factor in risk reward and also consider your win rate. And just to mention, win rate will require you to test and test your trades. You have to choose your trades carefully, right? You have to choose your trades carefully and know how many times am I likely to win. And this is what will help you to track the consistency and the drawdown. So in this case, when you're talking about this risk reward, there's a level where you draw the line, right? Such that if, for example, you lose 2 trades with your win rate, what does it mean? Do you keep on going for more trades and more trades, chasing the break even? For that, I'll move to the next slide. So we can visualize at least. Yeah, this is what we have. Let me clear the drawings. If you have any questions, please type it on the chat. Now, in this case, we are assuming a trader who takes 10 trades in a day. That's quite a lot. Yeah, 10 trades, maybe you're scalping on 15 minutes or 5 minutes for you to get 10 trades in a day. Yeah, quite a lot. But then you're risking $10 per trade. If you're doing $10 per trade, again, and with 10 trades, if you lose 10 trades, you're losing like 100. Then it means you need to have a very big capital. But this is a hypothetical case. Let's see what it gives us. So you're losing 10 trades. This means that if you have a 20% win rate, it's like you win 2 trades, you lose 8, right? You win 2 trades, you lose 8. And anytime you win only $10 plus 10. Anytime you lose, it's minus 10. 1:1 risk reward. That's what it means. So I've got a very low, out of the trades which you take, most of them you will lose. And then when it comes to your risk reward, the loss and the profit are the same. In this case, your chances of survival are very low. You'll be out of this market maybe with the first very few trading days. Okay, because what means is if you get 2 trades, if you lose 8, that's minus 80. You get 2, that's plus 20. Overall, you're negative 60. You're already on a drawdown, right? You are already on a drawdown. Okay. So in the event where you have such a very low level of win rate, then what you need to do is keep your drawdown to a very low level. Keep your drawdown to a very low level of your capital, and you need even a higher capital to survive in the markets. Because let's say, for example, if you've got $100 in your account, you cannot afford to lose $10 in a trade. In this case, it means you might want to go to as low as -1, so that if you were to lose 8 trades, then it means the whole day you've lost 8. So you might want to set your drawdown in a day to around 10%, which is also the higher side. But if you do 8, that will be 8%, still higher. So you want to consider the risk per trade, which is this -1 risk per trade, and then look at your win rate and the number of trades you place. Of course, you place 10 trades in a day. So if you do 1 times 2, you only get 2. Then you have -8. -8 and 2 going to place you at -6, right? So you want to take care of the risk and then consider your win rate and the risk to the reward. So in the event where you have 1:1, for you to achieve break even, it means you have to win 50% of your trades. If you place 10 trades, you win 5, you lose 5. And that's better. Okay. Because anything lower than 50% win rate will take you through a rat race in trading. And at this stage, this is where everyone else starts. You excited with every profit, any simple profit you get, or any indication of profit, you want to take it. You have like you have your stop loss at -3. If you get something like 2 or +3, you already close it very fast. So at this level, someone is struggling with proper targeting, with the strategy and all that. So at this level is where everyone starts, and we all strive to move to these levels, to move towards this direction. Now you have got a higher reward to the risk, and as well, your win rate is higher. But of course, the win rate can get stuck at some point because winning 60% of the trades requires quite a higher level of mastery of your trading strategy, a lot of back testing and all that, and experience in the markets. So if you have risk reward of 2, or reward to risk of 2 to 1, and with a low win rate of 20%, then it means you're already in drawdown. Okay. So if you have got a lower win rate, then you need to consider trades which give you a higher reward to the risk. And this is where we're looking at around 4 times the amount of loss which you're getting in the market. And that's where with the first trade, you're already in break even. Okay. For you to get these type of setups, then you also need to be pretty much good in looking at your trades or in finding your setups. So you're looking at a blend of, I don't even need a very big win rate. You're looking at a blend of the risk reward versus the win rate. Risk to reward versus the win rate. So a higher risk reward, for example, for a 4:1, then you just need a 20% win rate. So you can take this, right? For a 4-1 risk reward, then you're just looking to win only 20% of your trades, for example, for you to break even. That's what we're looking for. If you win 30% of your trades, then most likely you're looking at a lower win rate of around 3-1. And that's when you're likely to break even. If you can win up to 40%, this is where most of the traders probably are, 40%. What you need is just to play around with a 2:1. 40% and a 2:1. So this one seems to be a little bit ideal, considering that it's really challenging to know where the market moves next, right? And sometimes the price is very dynamic. What you're expecting to see in the markets, the direction that you've got and the trade which you've entered, and the trend just refuses. Let me say refuses. It doesn't move what you're expecting, the direction you're expecting. So in this case, you want to lock in a little bit, a modest risk, a modest reward to your risk. That is, if it goes twice your profits, then you can lock in that profit. And you can use all the methods, or any of the methods which we cleared, which we looked at yesterday. You can either scale out of the markets or trail the stop. Use a trailing stop. This one seems to be a little bit more ideal, because you don't want to go to 1:1. 1:1 will lead you to a rat race. And this is what you're looking at. So my challenge to you today is, do you know your win rate? Ask yourself about the win rate. Okay, win rate. But as you're looking at your win rate, consider your risk reward. Your risk to reward. Okay. And in the same case, you need to know how many trades in a day. For you to note this one, this is 1, win rate, 2, risk reward. Then number 3, you need to ask yourself, how many trades in a day? How many trades in a day are you looking for? Because the number of trades in a day will help you in knowing your win rate. You test and backtest up until you know, out of the trades which you place in a day, how many do you lose? How many do you win? And then that's when it's going to lead you to know which is the risk reward suitable for you to remain afloat in the market. So when you're looking at your trades in a day, the number of trades in a day, you want to set the maximum loss you expect, the maximum tenable loss, the maximum tenable loss, or the maximum amount of loss which you can allow, the maximum tenable loss in a day, or the maximum loss you can take in a day. So you know, you draw the line, the maximum possible trade, maximum tenable trade losses, or maximum possible losses in a day, or maximum loss tolerance, however you want to look at it. And in this case, it's likely to be your your playbook when you're trading. Because as traders, we tend to think that once you have a strategy that you enter will help you enter trades in the market and the trades hit a TP or protect at the stop loss, then that's done. You need to go deeper and study and put in place rules which are not commonly put out there in so many educational content we find even in social media and even in trainings. We will speak so much about trading strategies, analyzing the market, the newest trends and all that. But then we forget about win rate, risk reward, drawdown, and the number of trades in a day. So this is what I wanted to speak about today. Short, brief, but very essential for you to be consistent trader. So you want to consider and you want to test your strategy and see where are you in this map. So I'll be taking your questions if you have any. Let me know what you would want to understand better when it comes to risk management. Any questions? Kevu, are you here? Hey, Mercy, you here? Any questions? All right, I see the chart is clear. Yes, Kevu, risk management is really important. You have to do that's the only way you can sustain yourself in the markets. However, confident you are about your trading strategy, you need to do risk management to sustain yourself in the market, to ensure that when there is rain, when there is sunshine, whatever happens in the market, you are there. You're not depleting your account. All right. So up to that point, I don't see any questions coming up. So then wish you all the best in your trading. Keep risk management at the top of your cards when you're trading, and you have a sustainable trading. See you next time.